A liquidity crunch, consumers worried about a possible bank run, and mixed messaging. What went awry at Chocolate Finance? And what are the takeaways for people who want to make the most of their money? The news that Chocolate Finance was halting instant withdrawals caused a stir among consumers. Chocolate Finance is a robo-advisory platform. It calls itself a new place for your spare cash and promises 3.3% per annum on your first 20,000 Singapore dollars of funds. Also part of the deal, no fees, daily returns, and the ability to withdraw your money anytime. In February, the company introduced an Air Miles scheme. Customers could earn Air Miles by paying bills with the card. So many of them did so that bill payment volumes surged. In response, Chocolate Finance stopped card payments on the AXS machines that are used to pay bills. And that, in turn, led to a surge of customers redeeming their investments. On March 10th, the company temporarily suspended instant withdrawals.
I think a lot of them were very fearful because they thought it's a bank run, but actually it's not a bank run. I guess many of them who were so fearful and then they went to draw down, they thought that if they are too late, then there aren't enough funds in Chocolate Finance for them to draw. But Chocolate Finance is not a bank. It is really a digital platform whereby you put your money with them and they buy unit trusts. So your money is actually with a unit trust, and when you want to draw down, all the company needs to do is to sell away the funds. So the money will always be there.
Customer funds are held separately by custodians HSBC and State Street, and the company assured customers that their funds are safe and ring-fenced. But that wasn't enough reassurance for all its customers.
My son is a trained accountant. Right, so he understands P&L, financial statements, and he's been investing for quite a while, since as young as when he was 18. And then when this whole saga came, and people started withdrawing from Chocolate Finance, he texted me and he asked me, whether he should do the same, right? So my point here is, even for my son, a savvy investor, someone that's financially trained, his immediate reaction would be like that, right? What more consumers out there, men in the street, that they don't understand financial products and they don't read the fine print.
The sentiment was not helped by posts from financial bloggers or finfluencers. These content creators later posted updates acknowledging that their communication could have been better and that their actions caused unnecessary worry. But the finfluencers weren't the only ones sending out mixed messages.
For many, not just Chocolate Finance alone, over the last few years they've been operating cash management account, and although these platforms has openly stated that they are not a bank, but the marketing messages that have gone out may cause an impression that you are actually placing a deposit with a bank. For example, just the term cash management alone, people may think it is a deposit. Instead of using the term investment, which is actually really you are investing in short duration bond products, the term savings, they are being used. Instead of using returns, which is usually what we will use for investments, the marketing messages would say that it is interest rates, right? So all these marketing messages have gone out. I think for the man in the street, they don't understand investments, they don't read the details, they may think that it's a bank, and so when things like that happen, they quickly run in and try and withdraw the money as soon as possible.
The appeal of cash management accounts is that they offer relatively stable returns that are also highly liquid. So what are the questions you need to ask yourself if you're shopping for such an account?
Because you are investing in corporate bonds, even though they are investment-grade corporate bonds and even though they are short duration, they are still riskier than the T-bills. They are still riskier than the Singapore government securities. Obviously, because the corporate bonds in terms of risk is higher than a government bond, right? So you should expect yourself to get slightly higher than what T-bills and the Singapore government securities they are offering you. But the one thing I think consumers need to know is that because the underlying investment, they are unit trusts, they are investing in bonds, these yields are not guaranteed. Right? Even for chocolate finance, it's only guaranteed for a period of time during their so-called qualifying period. Right? They can't guarantee it forever.
Chocolate finance has now resumed withdrawals, and customers have started receiving their requested funds. The Monetary Authority of Singapore says it continues to engage chocolate finance to ensure that customer withdrawals are met in an orderly fashion.
I think going forward, this is a good lesson for the Singaporean investor. I mean, don't just be so on the marketing messages. Understand the platforms, the distribution channels that you are buying these products from, so that when there is a swing, when there are news, whether you hear it from influencers or anyone, well, you know what you're investing and you don't have to panic. I think the second takeaway for all financial institutions is when we market a certain product, we need to be very careful. We need to balance between making the product looks attractive with making sure that the messages that we send out, we don't confuse the investors. We don't make them think that our product is a certain kind of product when it's actually not. Because, when things like that happen, people panic. And not only we impact our investors, our clients, I think it causes us to lose our reputation. Yeah, so I think that's something that I think this whole chocolate finance incident is a good time for reflection of the industry and think about what we have done wrong and how we can do better.